A nurse working 12-hour shifts pays a higher tax rate than a billionaire, not sometimes, not in rare cases, consistently, legally. And the billionaire's accountant will tell you this is completely fair. Here is the number that should stop you. In the United States, the top 400 wealthiest individuals paid an average effective tax rate of 23%. The average nurse, teacher, or office worker pays between 22 and 32%. On paper, the system looks progressive. In reality, it runs in reverse. And here is the part that makes this so difficult to talk about. This is not corruption. There are no briefcases of cash changing hands in dark rooms. Every single mechanism I'm going to show you today is completely legal, written into the tax code, available to anyone with enough money to use it. The tax system was not broken by the wealthy. It was built for them. Today I'm going to show you exactly how. Here's the metaphor I want you to carry through this entire video. Think of the tax code like a highway. Everyone is driving on the same road, same speed limits posted, same rules on paper, but the wealthy have access to a network of private exits, legal shortcuts that let them bypass the tolls entirely. These exits are not secret. They are not hidden. They are just expensive to find and use. A tax lawyer costs $500 an hour. A sophisticated tax structure costs tens of thousands to set up. If you earn $60,000 a year, those exits are not economically accessible to you. So you stay on the highway, pay every toll, and arrive at the same destination with considerably less money. The exits exist, you just cannot afford the map. This is the entire story. Everything else is just the details of how those exits were built, who built them, and why they are still there. Let me show you the real numbers with two people. Meet Emma. She is a registered nurse earning $75,000 a year. Her income comes entirely from her salary. She pays federal income tax, Social Security tax, and Medicare tax on every dollar she earns. Her effective tax rate, what she actually pays after deductions, is approximately 24%. Now meet Richard. Richard is a wealthy investor. He earns $2 million a year. But here is the critical detail. Most of his income does not come from a salary. It comes from investments, stocks, real estate, business ownership. That type of income is called capital gains, and capital gains are taxed at a maximum rate of 20%. Not 24, not 32, 20%. Emma earns $75,000 and pays 24%. Richard earns $2 million and pays 20%. Emma works 12-hour shifts. Richard checks his portfolio once a week. The tax code does not punish wealth. It punishes labor, and it was written that way deliberately. Here are the 5 specific mechanisms that make this possible. Mechanism 1. Capital gains tax rates. When you earn money from working, it is taxed as ordinary income, up to 37% federally. When wealthy people earn money from investments, it is taxed as capital gains, maximum 20%. The tax code literally charges a lower rate for making money with money than for making money with labor. This is not an accident. It reflects a deliberate policy choice about which type of income to reward. Mechanism 2. The step-up in basis. This one is almost invisible and almost never discussed. When a wealthy person dies and passes investments to their heirs, those investments get a new cost basis, the value at the time of death. Any gains that accumulated during the owner's lifetime are completely wiped out for tax purposes. Billions of dollars in gains disappear from the tax base every single year through this one provision. It is legal, it is permanent, and it is almost exclusively used by the wealthy mechanism. 3. Carried interest. Hedge fund managers and private equity executives manage other people's money and earn a share of the profits. Those profits, called carried interest, are taxed at capital gains rates, not ordinary income rates. A hedge fund manager earning $50 million in carried interest pays 20%. A nurse earning $75,000 pays 24%. The fund manager is paying a lower rate on 667 times more income. This provision has survived decades of political debate because the people who benefit from it have the resources to defend it. Mechanism 4. Depreciation and real estate. Real estate investors can deduct the theoretical depreciation of their properties against their income, reducing their taxable income significantly. In many cases, real estate investors show paper losses while actually making money. The property appreciates in value, the rental income comes in, and the tax bill shows a loss. This is legal. It is called accelerated depreciation, and it is one of the primary reasons real estate has historically been a wealth-building vehicle for those who can access it. Mechanism 5. Corporate structure. Wealthy individuals do not just earn income, they move it through corporations, trusts, and legal entities that provide tax advantages unavailable to employees. Business expenses become deductions. Compensation gets restructured. Income gets deferred. The complexity is not accidental. Every layer of complexity is a layer of protection from taxation, and each layer costs money to build, which means it is only accessible to those who already have money. If this is the first time anyone has explained the tax code this clearly to you, subscribe, because this channel exists to show you exactly how these systems work and what that means for your financial life. YouTube will not show you the next video unless you do. Let me make this concrete with one scenario. James is 38 years old. He earns $85,000 a year as a project manager. He is good at his job. He gets raises. He is responsible with money. He pays his taxes every year without complaint because he assumes everyone pays roughly the same rate. James pays approximately $18,000 in federal taxes annually. That is 21% of his income gone before he makes a single financial decision. Now consider Margaret. Margaret inherited a portfolio of stocks and real estate worth $8 million from her parents. She earns approximately $400,000 a year in dividends and rental income. She has a tax attorney and an accountant. Her effective tax rate after legal deductions, depreciation, and capital gains treatment is approximately 15%. James earns $85,000 and keeps $67,000. Margaret earns $400,000 and keeps $340,000. James works 50 hours a week. Margaret reviews her quarterly statements. James is not losing because he is doing something wrong. He is losing because he is playing by the rules of a game that was designed for someone else to win. The highway has tolls. James pays every single one. Margaret took the private exit before the first booth. 3 things you can do this week. First, calculate your actual effective tax rate. Take what you paid in total taxes last year. Federal, state, Social Security, Medicare, and divide by your gross income. Most middle-class workers are shocked when they see the real number. Write it down. Then compare it to the 20% capital gains rate that applies to investment income. That gap is what this video is about. Second, open an investment account with tax-advantaged status. A 401k, IRA, or Roth IRA gives you access to some of the same tax deferral mechanisms that wealthy people use at scale. Contributing to these accounts does not make you rich, but it does move some of your income into a category the tax code treats more favorably. Use the exits that are available to you. Third, understand that this is structural, not personal. The tax code was not designed with malicious intent toward you specifically. It was designed over decades by people with specific financial interests, and it reflects those interests. Understanding this does not change the system, but it changes how you navigate it. You cannot change the highway, but you can start learning where the exits are. The wealthy do not pay less in taxes because they cheat. They pay less because they can afford the map. The map exists. Parts of it are available to everyone. Start there.